I get a lot of comments from you guys asking how I diversified my 401k portfolio. So I am fired up to talk about this because I've been wanting to make this video for a while. My 401k isn't exactly the same as yours because most of you watching my videos are W-2 employees. So you have some kind of employer-sponsored retirement plan like the 401k, 403b, 457b, or TSP. But the concept is the same. And I just get to contribute more than the normal W-2 employee because I'm also an employer. What I actually have is what's called a solo 401k because I'm a self-employed individual.
On solo.
I'm the only employer and employee for my company and the business I'm running. So I get to contribute to my solo 401k as an employee, and I get to contribute to my 401k as an employer. And I have a bunch of 1099 contractors working for me to help me run my business. So they don't technically count as my W-2 employees. But if one day I decide to hire a W-2 employee, then I'm not going to be able to contribute to my solo 401k because I'm not going to be the only employee anymore. When that happens, I'm probably going to have to switch to a simple IRA or SEP IRA. We'll see what happens. But what kind of sucks about my solo 401k is that I don't have a Roth option. I have the Schwab solo 401k, and the only option I have is the pre-tax or traditional 401k. I would very much rather pay taxes now than later. And when I contribute as an employer, I have to drop off a check at the Schwab branch. It can only be up to 25% of the company's net profit. For example, if Fireside Chat makes $10,000 in profit this year, then I can only contribute up to $2,500 to my solo 401k as an employer. The total contribution limit for the combination of employee and employer contributions is actually $69,000 in 2024. So $69,000 minus $23,000 in employee contribution is $46,000. So if I eventually make, let's say, $184,000 in net profit, then 25% of that would be $46,000. Anything over that net profit is still capped at $46,000. And if I max out my personal contribution at $23,000, and the net profit comes after all of the business expenses like research and development, software products, and educational programs. And I also keep a very detailed record of my total business assets, like all of the video equipment I have in my YouTube studio, as well as any cash and cash equivalent assets for my business, accounts receivable, and tangible assets. If you want to run your own business one day, I strongly encourage you to learn about how to manage your business finances in school or in a book. And there are a lot of resources out there that will teach you to do all of that, even on YouTube. Inside my solo 401k, I have 4 mutual funds and 1 ETF. They're all passively managed or what's called index funds, right? The first one is SWPPX or the S&P 500 index fund. At the time I'm recording this video, I have about 60% of the total portfolio invested in the S&P 500 index fund. Again, keep in mind that all of the money that I have invested in this solo 401k is from my business. I reinvest everything else right back into my business to build it so that I can make more videos like this, and I pay my video editors and upgrade software and hardware to give you a much higher quality video in the future. And I also have private clients who work on their finances to either pay off their debt or invest in their early retirement. So if you're interested in joining my private client program, you can schedule your first free 20-minute session with me by visiting firesidechat.com/coaching to see if I'm the right fit for you. And those slots are extremely limited. So if you don't see anything available yet, just check back on a weekly basis. The next one is Invesco, QQQ, which tracks the NASDAQ 100 index. This is probably one of my favorite index ETFs out there. It passively tracks the NASDAQ index, which has a very high growth potential that comes with a higher risk and volatility. When I say high risk and high reward, back in 2022, this ETF lost about 32% in value in just in 1 year, which was far worse than the S&P 500 index fund. In 2023, this ETF has performed over 54% return, which recovered the loss and some more. So from my experience with QQQ, if the S&P 500 goes through a bad year, NASDAQ is going to have a worse year. But when the market is having a good year, NASDAQ is going to have a higher reward. And to compare the top 10 holdings between these two index funds, the S&P 500 tracks the market cap of the 500 largest US companies. The top 10 holdings are Microsoft, Amazon, Apple, Nvidia, Alphabet, Meta, Tesla, Berkshire Hathaway, United Healthcare. And QQQ, on the other hand, Apple and Microsoft have the biggest holdings, followed by Amazon, Broadcom, Meta, Tesla, Nvidia, Alphabet, and Costco. It's not that any of these stocks are any more volatile than the other ones, but because QQQ tracks heavily on the tech stocks, while the S&P 500 tracks other sectors and not just the technology sector. And that's why I only put 15% of my portfolio into QQQ, because this is an aggressive growth stock ETF that focuses primarily on the technology sector. When the market does really well, I'm most likely going to have a higher return than the S&P 500 index fund. And the next one I have is what's called the SWLGX, which is the Schwab US Large Cap Growth Index Fund. This is different from the QQQ because QQQ tracks the NASDAQ 100, while the other one, or this one, SWLGX, tracks about 440 large cap US stocks, follows Russell 1000 Growth Index. And this fund in 2022 was down over 29%, but it's up over 42% in 2023. And this index fund only holds about 10% of my portfolio at the moment. And the next one I have is SWSSX, which is the Schwab US Small Cap Index Fund. And this one tracks the Russell 2000 Index, or 2000 small cap US stocks, or the small companies. This one holds about 10% of my 401k portfolio at this time. In 2023, it's finishing at about 17% return. The small cap stocks have been underperforming large cap stocks for sure for the last 2 years, but there are some indications of the rotation towards the end of 2023 and possibly going into early 2024. I don't know if you guys ever listened to Tom Lee on CNBC saying that the small cap stocks could climb as high as 50% in the next 12 months. That is extremely bullish, even for me. If he's right, this index fund, SWSSX, could hold a bigger weight towards the end of 2024. That would be fine by me, but it would be absolutely insane if we see a 50% return in small cap stocks. We'll see what happens. And the next one I have is pretty boring, but it is SWVXX, which is the money market fund that pays about 5% in APY. I'm only keeping about 5% in the money market fund to have some cash set aside. The only purpose of this money market fund is to potentially use it to buy more index funds, ETFs, or individual stocks in my 401k. If the market does drop, let's say 2 to 3% in one day, or 10% in a quarter, or 15% in like 4 months, there are going to be some good deals for me to buy additional securities. When the Feds start to cut interest rates in 2024, then I'm going to start moving some of the cash around to the mutual funds and ETFs, but most likely the ones that are underperforming the market. If the money market fund drops to about, let's say 3% APY by the end of 2024, then I'm most likely going to have this money rotated out to other securities that will perform much higher in return in the future. And to summarize the 2023 performances, I'm really impressed with how the mutual funds perform over the year. Am I going to see green like this every year? Of course not. When I made my stock videos back in 2022, I got laughed at in the comment section that I made bad investment decisions. What some people don't get is that a 401k is meant to be used for long-term investment, right? This is my insurance to make sure that I have income when I'm in my 60s without worrying about working a 9-to-5 job. So I didn't buy these mutual funds at a loss. I bought them at a discount in January 2023. I don't care what the mutual funds do in the short term. I'm a long-term investor. And the best performance was QQQ with over 54% return. But this is the result of a high risk and high reward. Just because I made a 54% return this year, it doesn't mean it's going to be the same in 2024. I always manage to maintain the same weight balance every year so that I'm not too heavy in these volatile index funds. This is my risk tolerance based on my current age, right? You might be much more risk tolerant or risk averse than I am. And I want you to keep in mind that how I diversify my 401k won't necessarily work in your financial situation. And my solo 401k in 2023 made a total of 28% return. And this reminds me of 2019 when the market performed over 29% return in that 1 year. How I also contribute to my 401k is entirely different than how the rest of you guys do it. Because again, I'm a self-employed individual who gets to contribute as an employee and as an employer. When I contribute to my 401k as an employee or an employer, I usually just make the lump sum contribution. And when you make your 401k, TSP 403b, or 457 contributions with your employer, you're already dollar cost averaging by investing it once a month, every 2 weeks, or on the 1st and the 15th. But what you want to try to do is get that employer match at the bare minimum and then try to maximize the contribution for the year. If you're not being able to max out the contribution just yet, start with a 15% contribution rate, then slowly contribute up to 25%. Don't just focus on the type of investment you choose, but really focus on your savings rate, because the math doesn't lie. If you truly want to replace 100% of your income when you're retired, you have to contribute at least 25% of your income towards your 401k, Roth IRA, and other retirement accounts. And I strongly encourage you to get your 401k calculator on my website at firesidechat.com/resources. It's absolutely free for you to use, to download, and you don't even need a credit card to sign up for my membership. Once you download the 401k calculator, take a look and see how much you'll have in 10, 20, or 30 years based on your current contribution rate.